Have you ever paused to consider how geopolitical tensions can send ripples through commodity markets? It's a fascinating, often overlooked aspect of our interconnected world. As global events reveal, their waves are felt far and wide, not least in the world of commodity trading. Today, we peel back the layers of this complex marketplace to understand how geopolitical tensions can create opportunities for the smart investor. Today, we're diving deep into this subject, exploring how global power plays can shape and shift the sands of commodity markets. A commodity, in its most fundamental sense, is a basic good used in commerce that is interchangeable with other goods of the same type. They are often the building blocks of more complex goods and services. Think oil, gold, wheat, or even coffee beans. These commodities form part of a vast global market, trading daily in colossal volumes. Commodity markets are where these goods are traded. Think of them as active bazaars with a digital twist, where buyers and sellers from around the world come together to negotiate prices. These markets are diverse, including the Chicago Mercantile Exchange for agriculture and energy products, the London Metal Exchange for industrial metals, and many more. These markets operate much like any other, with prices fluctuating based on supply and demand. However, commodities have a unique aspect. Because they are often natural resources, their supply and the cost to extract them can be dramatically affected by geopolitical events. But what happens when the unexpected strikes? Geopolitical events, be they conflicts, sanctions, or trade agreements, can all send shockwaves through these markets. A war in a key oil-producing region, for instance, can spike oil prices, while a good campaign in a major grain-exporting country might cause grain prices to decrease. Take, for example, the oil market. In the early 70s, the members of the Organization of Arab Petroleum Exporting Countries proclaimed an oil embargo against nations perceived as supporting Israel during the October War. This geopolitical event led to a significant increase in oil prices, creating an energy crisis in many Western countries. In a more recent example, the ongoing trade war between the United States and China has had a significant impact on soybean prices. As tariffs were imposed on this commodity, the price of soybeans took a hit. American farmers, depending a lot on buyers from China, faced a decrease in sales. The impact of these events on commodity markets can be profound. They can disrupt supply chains, alter demand, and trigger price volatility. This volatility can spell danger, but also opportunity for those who know how to navigate the tumult. 1. Supply chain disruptions. Consider a geopolitical conflict in a region that's a major supplier of a particular commodity, like oil in the Middle East. Such events can halt production, restrict shipping lanes, or damage infrastructure, leading to immediate shortages. The ripple effect is felt globally, as countries dependent on these supplies scramble for alternatives, pushing prices up. 2. Alterations in demand. Geopolitical tensions can also reshape demand patterns. For example, economic sanctions against a country can limit its ability to export goods, reducing global supply and affecting prices. Conversely, the end of sanctions or the signing of trade agreements can open floodgates of previously restrained supply, potentially lowering prices. 3. Triggering price volatility. This interplay between disrupted supply chains and altered demand is a recipe for price volatility. Prices can skyrocket or plummet, sometimes within very short periods, making the commodities market particularly unpredictable during times of geopolitical tension. 4. Navigating between danger and opportunity. Such volatility is a double-edged sword. For the unprepared, it can lead to significant losses. Hedging strategies, such as using futures contracts to lock in prices, become crucial for businesses relying on stable commodity costs. For speculative investors, however, volatility can present lucrative opportunities. By accurately predicting how events will impact supply and demand, they can buy low and sell high, capitalizing on market fluctuations. 5. Surviving the tumult. The key to navigating this tumultuous landscape lies in vigilance and strategic planning. Keeping abreast of global events and understanding their potential impacts on commodities is essential. Diversification, not just across commodities but also in investment instruments, can mitigate risks. Moreover, employing financial tools thoughtfully can protect against adverse movements in commodity prices. In essence, while geopolitical events can disrupt the seemingly steady flow of the commodities market, they also underscore the market's dynamic nature. For those equipped with knowledge, strategic foresight, and a robust risk management framework, these periods of uncertainty can unfold as periods of significant opportunity. These geopolitical events, while often causing short-term disruption, also present unique investment opportunities. As the saying goes, in chaos, there is opportunity. Understanding how geopolitical events can impact commodity markets can provide an edge, a chance to capitalize on price fluctuations. To do this, investors must stay informed. They must keep an eye on the global stage, understanding the potential impact of unfolding events, from trade wars to territorial disputes, on commodity markets. By doing so, they can anticipate potential price swings and position themselves accordingly. In times of geopolitical turmoil, the commodities markets often experience increased volatility. Investors, therefore, need to employ strategic approaches to navigate these uncertain waters effectively. Here are some main investment strategies that are commonly used in such scenarios. 1. Diversification. Spreading investments across various commodities and asset classes to reduce risk. The idea is that not all investments will be negatively affected by a single geopolitical event, thus mitigating overall portfolio risk. An investor might allocate portions of their portfolio to precious metals like gold, which often perform well during geopolitical crises, while maintaining investments in energy commodities, agricultural products, and perhaps even non-commodity assets for balance. 1. Hedging. Using financial instruments such as futures contracts, options, and swaps to protect against potential losses. Hedging allows investors to lock in prices or insure against adverse price movements. If an investor holds a significant position in crude oil and anticipates geopolitical tension in oil-producing regions, they might purchase futures contracts that profit when oil prices rise, offsetting losses in the spot market. 1. Safe haven assets. Investing in commodities or assets considered to be safe havens during times of uncertainty. These assets typically have an inverse relationship with the broader market and can retain or increase in value during turmoil. Gold is traditionally viewed as a safe haven. In periods of geopolitical instability, investors might increase their holdings in gold or other precious metals to protect their portfolio's value. 1. Tactical asset allocation. Adjusting the allocation of assets in a portfolio based on short-term market forecasts and geopolitical analysis. This active management approach seeks to capitalize on market inefficiencies or anticipated moves resulting from geopolitical events. If an investor anticipates that a geopolitical conflict will disrupt supply chains for a particular commodity, such as natural gas, they may temporarily increase their investment in alternative energy sources. 1. Contrarian investing. Going against prevailing market sentiment by buying commodities or assets that are currently unfavored but expected to rebound once the geopolitical situation stabilizes. An investor might buy into a commodity that has significantly declined in price due to an immediate overreaction to geopolitical news, betting on its recovery as the situation cools down. 1. Research and continuous monitoring. Staying informed about global events, market trends, and geopolitical developments. This foundational strategy supports all others by providing the data needed to make informed decisions. Regularly reviewing news sources, market analysis, and expert forecasts related to commodities of interest. Adjusting strategies based on new information and emerging trends. These strategies require a thorough understanding of both the commodities markets and the geopolitical landscape. Investors must also be prepared to act swiftly as situations develop, balancing the need for quick decisions with the importance of thorough analysis. In conclusion, geopolitical tensions play a significant role in shaping commodity markets. The commodities market is a mirror reflecting the world's geopolitical complexities. For those who look into it with insight and preparation, it can reveal opportunities as dynamic as the events that shape it. Join us next time for more insights that cut through the noise and guide you toward informed investment decisions. From the oil embargoes of the 70s to the ongoing trade wars of today, these events can cause dramatic shifts in commodity prices. However, for the savvy investor, these shifts can present unique opportunities to capitalize on chaos. The key lies in staying informed, understanding the potential impacts, and staying agile in the face of global uncertainty. If today's journey through the relationship between geopolitics and commodity markets has sparked your curiosity, Don't forget to hit the like button, share with your fellow investors, and subscribe for more financial enlightenment. Until we meet again in the Enlightenment Corner, stay savvy, stay informed,